Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi, good day, everyone. How are you going? Welcome to the podcast. Thanks for tuning in as we navigate the property markets, what's going on for property investors right across the nation. And if you've been tuning in over the last couple of months since we kicked off 2020, great breadth of commentary we've been having from property investors, some of them just kicking off, some of them with very large portfolios. We've also been very fortunate to have a number of people into the studio to talk about what's going on in the market right now. And as we shift into 2020, property data is a key tool for all property investors. It can give you a lot of insights in how and where you should be directing your efforts in assessing where to be investing. Not all data is created equal. There's some very good operators out there. There are some less so good operators out there. And one of the better quality data providers, I feel, SQM Research. I've asked their managing director into the studio with me today to chat things all through property. Louis, Christopher, how you going? We've known each other for many, many years. It's been your first time on the show, though.
G'day, Phil. Yes, well, under your format as it currently stands, yes. I think we've done a few things in the distant past. But yeah, it's good to be here.
So not all property data is created equal. Fair comment, fair sentiment?
I think that's a fairly fair sentiment, no question. I think from our perspective, what we try to bring to the table is transparency. No matter what the markets do, we're there to report. We want to be the first to report on it and get it right.
You guys have been at this for a little while now. We used to print vacancy rates, I think, in the Smart Property Investment magazine way back when.
Yeah, that's right. That would have been 2007. Yeah. I think we got that going.
Wow.
So yeah, that was our first index we released. And look, by way of a background, we got SQM Research going in 2006. And prior to then, I was 6 years as head of research and then general manager with Australian Property Monitors, which is now domain owned. So that's probably where the professional background came from. And before then, it was an editorial background. And then I spent some time with funds management as well. And then, of course, there's the personal background. So I bought my first property, which was an industrial property when I was still at uni, 23 years old.
Okay.
That was fun. That's how I got my hairstyle.
So how has property data changed in sort of the last 10 years? Is it still the same metrics or has it evolved quite a lot since?
Well, when I first professionally got involved with property information, there wasn't actually a lot of information available for people. And the organisations that were dominating the information publication were actually the REIs. So the Reserve Bank at the time was publishing a median house price from the Real Estate Institute. All vacancy rates came from the Real Estate Institute. Median house prices came from the Real Estate Institute. Organisations such as RP Data and Australian Property Monitors are more or less in their infancy, but growing. RP Data at the time was just Queensland-based. And one of the first things that happened when I was at APM is that we actually became national. So we were just New South Wales-based at the time, and then we moved nationwide. So since then, there's been a lot of evolution. Arguably, there's probably too much information out there now, and we've kind of gone full circle because I think many investors get confused with the various sources of information and the various different methodologies.
Yeah, I completely agree with you. And we have a lot of people coming into the studio, property investors, and they just get over-consumed by just how much information is out there and they can never make a decision, right? And property data is one of them. So it's really understanding what data really counts and what really matters and, you know, what you actually need to know in order to make a more informed investment decision. Now, in terms of SQM, who's the biggest consumers of your data? Is it the sort of larger, just sort of investment houses, or is it sort of mum and dad investors?
Oh, it's a combination. Where we have mums and dads at the forefront, and they're interested in some of our reports we have there for them. For example, we've got a distressed properties report. That's probably our biggest seller. We also have financial institutions who buy our data. We also have a number of government departments who buy our data as well.
What's a distressed property report? Do you actually list which houses are, or which people are distressed?
Oh, yeah, this is fun. So this is basically a list of properties that are being advertised as, for example, mortgagee in possession, divorcee sale, vendors overseas needing to sell now. There's about 50 different keywords we look up that could be regarded as distressed. And with that, we then provide the marketing history of that property, what it last sold for, and our customers can also look up the current valuation of that property.
So you pretty much just aggregate all the information out there with distressed properties, put it in one report and sell it. Is that pretty much how it works?
That's it.
Okay. And that's pretty valuable for property investors, I imagine.
Oh, yeah, they love it.
Yeah.
Yep.
And then what, does real estate agents just get bombarded then when, these reports come out if you end up on this distress list? Or are you responsible for the sale of most of them?
Well, let's keep in mind that they're being advertised as that in the first place. So it's not like as though we're grabbing a property which is not being advertised in that way and saying this is a distressed property.
Yeah.
So... yeah, look, the feedback we get from agents is quite positive. We normally in our weekly newsletter run with the distressed property of the week, and I get many calls from agents asking if we could put their property in for the next newsletter. So we're not selling that space. We just simply take what we think is an interesting property out of the list and putting in our newsletter.
And for you, is the number of distressed properties that you identify in any given time indicative of the health of the economy? How do you map it? And what did you see last year? Were a lot of people hurting last year?
Well, at any point in time, there's between 18 to 21,000 distressed listings.
Is it that many?
Yeah, and that does sound like a lot, but at any one point in time, there's about 350,000 listings around the country.
Okay.
So that just gives you an idea in terms of the ratios. You want to hear the region that regularly comes up top?
I was going to ask you, let me guess.
Guess.
Newcastle.
No.
I was going to say Anna Bay. I know they don't pay their mortgages. Okay.
Second guess.
Is it a mining area?
No. It's a holiday area.
It's a holiday area. Sunshine Coast.
Close.
No. Okay.
You're getting close.
Really?
Yeah.
Cairns Way?
All right.
Yeah.
Gold Coast.
Gold Coast. Is it really?
Yeah. Yeah. And I put it down. It's regularly up there. And I don't think it's because the Gold Coast is necessarily having problems with its property market, but I think it's more to do with the fact that, look, the demographic tends to be rather transient.
Yeah.
People get married and then they divorce up there and they move on, and people do come and go.
So are they investors that are distressed, or are they owner-occupiers who are distressed? Or you can't.
I think it's predominantly owner-occupiers.
So can you actually identify that in your data? You can't, can you? Well, sort of.
When you see things like divorcee sale or deceased listing, things like that, more often than not, they're going to be an owner-occupier property.
So in terms of where we are today versus where we were 12 months ago, or where we might have been sort of 3 years ago in terms of distressed property, is it pretty consistent? There's always distressed people for whatever reason. Yeah,
look, it hasn't really blown out. And I think that, so there's never really been a spike in our numbers since we've been doing it. It's been fairly consistent between 18 to 21,000 properties in the list. And I think that's fairly consistent when we look at overall default rates provided by the banking sector. There's not been in the last 5 years a real spike in default rates. They've been gradually rising, but it's still from a very, very low base. So basically under 2% of mortgage properties out there get to that point. So no, we haven't seen a spike as yet. Mind you, we haven't had a recession now coming up to 30 years?
Yeah, nearly.
So we'll see what happens.
And do you have a metric or a mechanism to just identify how distressed the property might be?
No, it's hard to tell how distressed it is.
How distressed it is.
I guess the longer it's on the market, potentially the more distressed it could be.
Now, how do you find real estate agents being responsible for distressed properties? Because a lot of times, something can languish on the market for a long time. It's just been marketed incorrectly. It might not necessarily be distressed.
Yeah, that's a fair comment. As mentioned, these properties are being advertised in this way to begin with. That's how we know about them. So it is definitely the wording in the advertising which ends up making that property go into our list.
Yeah. Interesting. Look, I want to have a chat about vacancy rates and stock on market, because that's two sort of key indicators around the health of any particular property market and whether or not there's opportunities for property investors. But we'll just go to a break beforehand, just back in a moment.
If you're a regular listener to the Smart Property Investment Show, then odds are you're already a property fanatic who loves hearing stories on investing from real people, the good, the bad and the ugly. Be with people just like you and join the group Passionate Property Investors on Facebook now. Become part of a community who know what to do and when to do it. And the time to do it is now. Passionate Property Investors. Tribe, tools and tips. Find us on Facebook today.
Welcome back, everyone. Here with Louis Christopher, Managing Director of SQM Research. Vacancy rates, way back when we started chatting, and we've been sort of in this property game. You've been in it for a lot longer than I have been, but we've known SQM for many, many years. Vacancy rates as a tool for property investors to work out where to invest.
Yeah. It helps provide a reasonably good measurement on the strength of the rental market. And we have a series which starts from the national level and goes all the way down to the postcode. I think we're still the only organisation providing rental vacancy rates at the postcode level. And yes, it's been a very reliable indicator over time in terms of the relative strength of all the various rental markets out there.
And for you and your organisation in creating these indices or these packages of information around vacancy rates or whatever else it is, do you offer any interpretation on them or narrative around them, or is it more of a here is information, make your own decision or determination?
We definitely provide a methodology. So all visitors to our website, when they go onto the vacancy rates area, which we do provide the charts for free, they will find a methodology link which explains exactly how we've actually calculated the vacancy rate. So my intention with this business has always been transparency first, no matter what. Interpretation of the vacancy rates, that's an interesting one. We've given our guides out there in terms of where we think the number represents a strong market or a softer market. I've found over time it's not only just the absolute number, it's also the direction, the trend of the vacancy rate. So, for example, we've seen areas where the vacancy rate has fallen from, say, 10% down to 7%. 7% is still an oversupplied market, but it's actually created a rise in rents because the weekly rent, basically has been reflective of the vacancy rate of supply and demand at that time. So if you suddenly see a tightening in supply or an increase in demand, it does have an impact upon the market rent in that area.
And what would be your recommendation or insights for property investors around using property data? And, my view is that you can't look at each individual thing in isolation. It's got to be a narrative or a story around it. And vacancy rates is one thing. Just trying to find an area which vacancy rates are decreasing tells you one story, but that is always in relation to property prices as well. So how do you use these things to be informed?
Well, firstly, I think your listeners should be aware that there can be quite a disconnect between the rental market and the sales market. I've seen many a time when the rental market is tightening, but the sales market's falling, and vice versa. And then there's other areas where there is actually a connect. So Perth is a classic example where the housing downturn, which started off back then in 2014, was led and driven by the rental market first. And then the sales market fell thereafter. We're noticing now in Perth that rents have been tightening again, so vacancy rates have been falling. And we believe that we will see this year a rise in prices accordingly. We think it's going to feed through to the sales market.
And these are all the information you provide us in your reports and narrative that people can get from SQM Research, I imagine.
Yeah, so firstly, when people come to the site, they'll see that we provide a lot of free data, and not just on property, we cover shares and funds as well. And then we provide an annual report, which we call the Housing Boom and Bust Report, which I've been doing for quite a few years now. So this is my own personal work, and that provides forecasts and ratings of every locality in the country for the year ahead.
And we're chatting about these terms sort of quite quickly, and I'm conscious that a lot of our listeners might not actually know what a vacancy rate is. Sort of getting back to basics on this, and we probably should have cleared this up. What is a vacancy rate, Louis?
So this represents a property that has been advertised for rent, but it is our view that that property is currently unoccupied and still available for rent. So number one, it's got to be advertised for rent. Our methodology states that we don't have the resources to send out a survey out to every property. So we make an estimate that if a property's been advertised for rent for over 2 weeks, the odds are it's getting to the point where it's unoccupied as well. And that we then include that in the count of a vacant property. Then the denominator is our estimate for the number of established rental properties in the area. And how we get that number is we have a very good address database, And we also use the census data to give us an estimate in terms of what splits there are owner-occupied versus rental date properties.
You just live in this data world, don't you? This is pretty complicated stuff there. How does it work within your brain? Is it sort of just numbers and facts and figures floating around, or
I think
just in the blood?
I've had a natural curiosity on markets all my life, right from the year dot. And it's not just a property market; it's a stock market as well. And I just enjoy the work. And I think what got me into this business it was actually initially the lack of information and sadly seeing people getting ripped off within property in particular. This goes all the way back to the 80s. So that sort of moved me, and the love of investment markets plus a real wish to improve information out there. So it's brought me here.
I know you do a lot of media, and you often see on the telly or in the papers or whatever these horrible stories of people buying investment properties which they should never have bought for whatever reason. And I think a lot of people outsource the responsibility for investing in property to other people, whether it's good salesman in a slick suit selling you some off-the-plan property or whatever it is, and they get told what they want to hear, and therefore they make buying decisions around that. Largely, there's no excuse these days not to be informed about property investment. There is so much information out there now, whether it's a podcast like this or the information that you're providing. But you still see people doing what they've always done, and that is just blindly buying property, which is the most expensive thing they're ever going to buy. Do you think it's ever going to change, or it's just the way it's wired? You must sit there sometimes and just shake your head, right? Going, all you had to do was look at one thing and you would have made a different decision.
There's a lot of emotion in real estate, especially for owner-occupiers. Every property is unique. You come across a property you love, it's hard not to get taken away with it. And ultimately, many people do end up overpaying for a property. Yeah, look, it's difficult. As mentioned on the outset here, we've kind of come full circle now where there's so much information out there, people are getting confused and they're kind of just wiping it all away because they don't trust any source. They're so confused. And so that's concerning. So, look, it'll probably continue on forever. That will sadly have people who will make decisions which are going to burn their wealth.
Yeah, and a lot of the time people make decisions based on what someone told them at the barbecue or what the taxi driver said. And, if you sound like one of those people, maybe you should start maybe expanding your horizon a little bit more and looking elsewhere for information. Now, when you're looking at property markets, so there is a whole bunch of different ways and different measurements, both macro and micro economic factors or whatever, to help shape your investment decisions. One of them might be stock on market. Now, stock on market, Louis, is just how much stuff is available at any given time. Let's have a chat about this. And I know you do a lot of work around this and you've probably got a lot of numbers for us. What is stock on market? Can you give us just a top line description of what it means and how to use it?
So stock on market is total listings that are out there. And so it's a measure of supply. We love measuring stock on market over time because we want to see whether supply is increasing or decreasing and why is it increasing or decreasing. Generally speaking, we find it in stronger markets, stock on market falls. And then in weaker markets, stock on market rises. Why? Well, during a stronger market, there's more buyers out there and they absorb the stock. They buy the stock that's out there and so stock falls. During weaker markets, not as many buyers out there, as many sellers, and the stock keeps on accumulating because it's not selling and so stock rises. Now within that, just to hopefully not confuse your audience, you have new listings and you have old listings. Okay, and you'll find that agents like to focus on new listings because that's what they think they can sell. Whereas old listings, they're old, they don't think they've got much of a chance to sell for whatever reason. So at the moment, we're actually finding that new listings are rising, but overall listings are falling in Sydney and in Melbourne and in Canberra, as well as Perth, if I recall. And so what that's telling us is that there's more buyers and sellers, but there are new sellers coming to the market because they're becoming more confident that they're going to be able to sell in this stronger market.
Okay. And depending on the markets, Sydney, Melbourne, Canberra, with money relatively cheap, if you can get it, well, it's very cheap, you can get it, but there's a lot more people coming to the market. There's a lot more confidence in the market now running into 2020 compared to 2019. If you think back to June, July, there's no one out there, right? So can you give me your view of how you explain these markets right now? Are they sellers markets in these key capitals?
Yes, they are increasingly becoming sellers markets, some more so than others. One of the things we're noticing is that the various markets have become a little bit more in sync. So most markets right now appear to be on the rise, whereas a couple of years ago, it was each local market to itself. So what's caused that sort of in-sync move upwards? Well, it was a surprise federal election victory by the Liberal National Party to start with. And on our indexes, we believe that the market bottomed very shortly after the election victory.
Okay.
So let's go back in time. This time last year, it was still looking like Labor was going to win. And they had a plan to change negative gearing and also introduce capital gains tax. And so a lot of market participants in the housing market did not have a lot of confidence at all. It looked very likely we would see a fall in prices as a result of those changes and eventually maybe a rise in rents. That didn't materialise. So the market was surprised on the upside by the election win. On top of that, we had interest rate cuts as well, if you may recall, which historically has always given the market a bit of a boost. Then on top of that, we had the tax rate cuts and we had the banking sector loosen up credit. So it became easier last year to borrow money compared to, say, 2017, 2018. So all that combined has been real stimulus for the market. And so we're seeing price rises now in all cities from what we can see except for Darwin.
And stock and market then will have a relationship with those dynamics that you've just mentioned. A lot of people during sort of 2019 probably concerned about what their future might hold and then weren't putting their properties up for sale because they didn't think they're going to get the price they're going to get, or the market was still heading south. Whereas you've said that essentially as soon as the election happened, there was some certainty around who the government's going to be. That was the end of the price drops in real estate, That's a confidence-led thing.
That's right.
How quickly have you seen it rising, the sort of property prices, but stock on market in conjunction with that, like new listings, are buyers now going, hang on a second, I reckon I can get a good, nice price for my property because there are a lot more buyers in the marketplace, and I want to get an auction clearance rates in a moment, but can you give me some context of how the stock market has changed around the different capitals?
Yes, so basically year on year, the numbers are quite interesting. So if we consider Sydney, listings have fallen year on year by 25%. Okay. So they're down 25% on where we were this time last year. Over in Melbourne, they're down by about 12%. Brisbane, they're down by about 8%. Perth, they're down by 14%. In Adelaide, they're kind of steady, just down by 0.2%. Canberra, they're down by about 12%. Darwin, they've actually fallen by 25%, but yet prices are still falling in Darwin from what we can see. But that is a sign potentially the market. It is about to bottom out in Darwin. And Hobart, they're down by about 8%. So as you can see there, year on year, they're down in all cities.
And that's because people are buying more properties?
Yeah, I think as a result of more buyers out there absorbing the existing stock. And when I say that, going back to my comment about new listings versus old listings, if we were to look at just new listings, so stock that's just been on the market for the last 30 days, they would be up on all cities compared to this time last year.
Okay.
So vendors are coming to the market now, new vendors that is, and the old stock, it's finally being moved.
So on that basis, would you say that the stock that's been sitting on market was just for a while, has just been pricing correctly for where that market is and now it's just caught up?
Yeah, look, 99 times out of 100, it's all about and a price that was too high compared to the market. The truth is, of course, that many vendors get ahead of themselves in terms of what they think their property is worth. And the problem is that for vendors, when they're just listing their property, those first few weeks are all critical. That's where you're going to get the most interest, is right at the beginning. If you've got your pricing wrong compared to the true intrinsic value of that property, you're not going to sell. And it's the case with strong markets as well. And so once you click over that 3, 4, 5 week period, the property in slang terms becomes stale. And buyers start wondering if there's something wrong with the property and they stay away. So it can have quite a negative effect if you get your pricing wrong to begin with. But in a rising market, eventually the market does catch up. And that's what we saw last year, particularly in Sydney and Melbourne, where many vendors finally got the price they wanted, or they negotiated as well to meet the new market, and they sold. And hence the reason why total stock has fallen.
And in discussions with real estate agents, are they all walking around with their head buried in their hands and slumped shoulders, or are they a little bit happier these days? They're obviously moving old stock, but they're all scrambling to get more stock.
Yeah, they are. Look, agents always want more new listings. That's their way to get to their commission. Yeah, this time last year, I think there was a lot of negativity in the industry. Just when I was going around speaking to larger real estate agency groups, that's the feedback I was getting. And I think that actually had an impact upon the economy as well. I mean, the real estate agent industry is quite large. There's probably about 14,000 agents out there. And when times are good, they tend to go and buy new cars. When times are bad, they don't buy new cars. And sure enough, last year we had a real slump in new car sales.
We did, didn't we?
So, yeah, they can have actually an impact on their own in the economy. But I do believe that things have turned around for agents. We're seeing in our numbers that sales rates have definitely picked up, and that's also, you can see that through the higher auction clearance rates that we've been recording as well.
Yeah, I want to chat about auctions, but let's go to a break beforehand. Back in a moment.
Are you 100% satisfied with your current property manager? Tired of chasing them for updates? Is making more money from your property investment important to you? With your Bonza, you get one platform, one point of contact, and one low management fee. For greater ROI from your property investments, visit landlordroi.com.
Welcome back, everyone. Here with Louis Christopher, Manager Director, SQM Research. Now, we've been chatting about stock on market and the relationship of stock on market with property markets and how these two things work. Sort of moving into sort of mid to the latter part of 2020, your view before we get to auction, Louis, there's going to be a lot more stock coming onto the market.
Yes.
Yes. And what's going to be the driver of that? All those things we spoke about, cheap money, etc.
Cheap money, vendor confidence in the market. So vendors are believing now that they're going to be able to get the price that they want out of their property.
Okay.
That's what's going to predominantly drive it.
So it's purely supply and demand dynamics, right? You know, can I get the price I want? Do people want it? Happy days, let's go.
That's right.
Okay. And in a market which is increasing, so where stock might be tighter, so it is a buyer's market. Traditionally, you'd find that a lot of agents will take properties to auction because there is a positive pressure for upwards price movement on it. Is that a fair assessment?
Yeah, I think market participants, sellers generally will want to list their property via auction in a strong market, but there is a perception that in a weak market, auctions are not the way to go. Look, in terms of sales methods, I don't think there's any foolproof method. I don't think there's any perfect method out there. Generally, people either sell via private treaty, they sell via auction, and some sell via a tender system.
Yeah.
By and large, the majority of properties are actually sold via private treaty. Auctions generally are used in the larger cities, Sydney and Melbourne, Brisbane, Adelaide as well, but in the inner city areas predominantly. Although I've noticed increasingly in Sydney that auctions are increasingly being used in the middle and outer ring as well. So look, as mentioned, there's pros and cons to both. Auctions can be a rather transparent way of selling. For buyers, they can get to see the competition as opposed to an agent saying, oh, we've got an offer from somewhere else, and that's all they tell you, right? So I like that part, but of course, auctions have had their issues in the past, namely dummy bidding, underbidding. Now, I'm seeing less of that these days because we have had a clampdown. The laws have been tightened on that, and I think that's had a positive impact upon the market. We still, though, when it comes to the auction aggregated numbers, we can still have conflict out there. And there's, once again, different bodies reporting different auction clearance rates. And some have a more optimistic methodology and others have a rather negative methodology in terms of how to calculate that auction clearance rate.
And you're measuring these auction clearance rates now yourself, is that correct?
Yes, we're now making our first steps to do that.
Okay.
So
it's a bold new world, is it? Brave new world?
Yeah, back to the future kind of thing. Because I was, when I was at Australian Property Monitors all those years ago, I was responsible for the auction monitoring team and ensuring that we get the auction results in on the day. It's quite an exercise, let me tell you.
How does it work? Because, you know, a lot of time you've got to call up the agent and go, did it sold, did it not sell, how much to go for? And they tell you, get stuff I'm not telling you.
That's right. Yeah. So when I was doing back then, there was a lot of phone calls. So, you know, we had a team of 15 on a Saturday afternoon ringing up agents. So, and of course, back then, most listings were in the paper. So we also had another team of 20 to 30 people every day of the week just typing in the advertisements off the newspapers around the country. You should have seen this room, Phil. It was just full of newspapers.
Madness, no doubt.
It was crazy. So fortunately, we were able to move to the online world where auction monitoring of the advertising became a lot easier. So, yeah, it's quite an exercise. Very challenging to get a proper auction clearance rate on the day. So you'll see the big organisations such as Domain publish an auction clearance rate on the Saturday evening. And it's usually a preliminary clearance rate because they haven't been able to get all the auction results out of the agents. And there are many reasons why agents cannot report or will not report on the day. Some of them involve the fact that the agent's just simply overworked. He just cannot
enough
get to
going
it.
at the time.
That's right. There can be also other darker reasons. For example, it was a bad result, and we're talking about an agent who is known to do auctions. He or she doesn't want that negative information out there. Then, of course, there's not a lot of agents out there who actually boycott results, providing results on a regular basis. They do not want to give it to the large organisations. They're actually quite disenchanted with providing this data to such organisations who basically profit from it.
Okay. And so why do auction clearance result rates matter, like for a property investor? What do they tell you?
Well, they've been, over time, a very reliable indicator in terms of the strength of the market. And for me, I've been able to use that information to pinpoint turning points in the market. So they've been very good, a very strong indicator in terms of where the market is heading.
And where is the market heading from what you've seen so far? Well, number one, how are you going to capture all this information? So, and your methodology towards creating auctions clearance rate versus maybe your domains or your CoreLogics or whoever?
Well, that's right. Well, as announced, and I've put it through Twitter this week, that, look, SQM Research is now making steps towards independently providing another auction clearance rate number. So we'll be providing a full methodology. We're taking it one step at a time. It is quite an exercise, and the first step we're doing is literally providing a schedule, a full list of all up-and-coming auctions.
Okay.
So it'll say the date, the time. It'll be a very easy list, and there'll be some aggregated statistics around that list. So that'll be the first step. And then the next step will be, I move towards providing our own auction clearance rate.
Does that mean you've got to work Saturdays now?
I hope not. Look, this is, for me, very much unfinished business.
Yeah.
So I'm very excited that we're moving in this path finally.
And to start doing auction clearance rates in this particular market, there must be a rationale for it. Is it because you feel a lot more properties in the big capital cities are going to be going to auction over the next sort of 2 to 3 years? Or
I think the proportion of auctions to the total market have been increasing in the major cities over a number of years now. More and more vendors believe that auctions are the way to go. Whereas when I started out in this industry, most property was sold via private trading and still is. So let's not kid ourselves. Even while auctions get a lot of advertising, they still only represent the minority of the market. But it's still a big enough sample, particularly in Sydney and Melbourne, to get a good gauge of what the market's doing week by week, as opposed to waiting for, say, sold records that come through from the Valuer General, which can be like months behind the market.
So just to give our listeners some context, what percentage of properties, say in the capital cities, would go to auction?
In a normal market in Sydney, the number would be 15 to 20%.
Okay.
That's for Greater Sydney. Now, in a ring, it'd be a lot higher. It'd be like 70%.
Okay. But Greater Sydney, that's okay. And how many listings would be in the Sydney market any given weekend?
Well, for this coming weekend, we're actually got about 420 properties going to auction this Saturday.
Okay.
And the market's just opening up. When we get to the end of February, that number for Sydney will be in the order of about 800 properties. For Melbourne, the numbers are higher. Melbourne's always been the number one auction town. So Melbourne, for this Saturday, if I recall the number, there was about 642 properties going to auction. And that number will get up to about 1,000 when the market fully opens at the end of February. Okay.
There's a lot getting transacted. And, conscious of time, Louis, give us some, if 2019 was a tale of two halves, pre and post federal election and what they did to property markets, what's going to identify sort of 2020, do you think?
Oh, really good question. Okay, the scenarios. Will the Reserve Bank of Australia cut rates? Number one. If they do, that will stimulate the market further. If they don't, market will continue on in its current trend. So definitely watching what auction clearance rates do. Number two, of course, there are concerns about the economy, and everyone knows about the coronavirus. The coronavirus is certainly not, from what we can see, currently impacting the housing market. However, if we were to see a situation where global events create a recession in this country and unemployment starts to rise, that would have a negative impact upon the housing market, no question. Number 3 is the Australian Prudential Regulation Authority, otherwise known as APRA. Now, APRA has been the body that's been restricting or loosening up credit, telling the banks what to do in terms of where they need to set their loan-to-value ratios and so forth. In 2018, APRA started loosening credit conditions after they were tightening between 2015 to 2017. It's possible, if the market keeps running hot, that APRA may well step in the market later this year.
Slow down again, you reckon?
Yeah, it's possible.
What, they'll put a cap on investment lending? Is that how they'll do it?
They could do a whole bunch of things.
Yeah.
So for now, their language is that they've been welcoming the price rises. What they don't want to see is an acceleration in credit growth. So they're okay with rising prices, but if they also see with that rapidly rising credit growth, housing credit growth, they'll come into the market. Right now, we're not seeing that rapidly rising credit growth, but there are some signs that it's coming. So we know that housing finance approvals have been bouncing, and housing finance, that feeds through to credit. So we've assumed that the odds are that the APRA will stay out of the market this year.
Okay.
But if the market does keep on rising, I think the probabilities are fairly strong that they may well re-enter into the market next year.
Interesting. So property's going to go up? It's going north. Did you give insights or predictions on price growth in the capitals?
Yes. So look, each year we've got our housing boom and bust report. We normally release that late October, early November for the year ahead. And yes, we released with that our forecasts, which were widely published at the time. Quickly going through it, our base case was that Sydney would rise in 2020 by between 10 to 14%. Melbourne was 11 to 15%. Brisbane was 3 to 6%, so was Perth. That was the forecast that Perth would finally bottom out and rise. We're still forecasting falls for Darwin. Tasmania or Hobart, we were forecasting that this would probably be the last year of price gains, and all the easy wins have been taken. Adelaide, it was going to be some slight price rises. Canberra, if I recall the numbers, it was a 5 to 8% forecast increase in prices.
So it sounds like not a bad time to be in property or investing in property.
Yeah, it's going to be a good year for vendors.
Yeah.
No question about that. But I think with this, Phil, with this current cycle we're in now, I take the view, the cautious view that, look, I don't know whether this cycle is going to be as long as the last. I think the odds are pretty high that sooner or later it's going to be either the Reserve Bank or APRA step in the market and try and slow things down again.
Yeah. Well, I bought in Sydney late last year, so I think I bought at the right time.
You did well.
Yeah.
Yes.
Not too bad at all. But and all those numbers that Louis just mentioned, we reported on them on smartpropertyinvestment.com.au, so you can go and check it out and have a look. Thanks for coming in, mate. I really do appreciate it. I have to get you back in again and tell us what's going on.
No, good to be here. Thanks for having me.
And when do you officially launch your clearance rates mechanism? Is that this weekend?
Oh, well, I've just put some numbers out there. So what will happen next is that we'll be putting out our list in our weekly newsletter that comes out each Tuesday.
Okay. And we'll report on that as well. So get over the numbers to us and we'll make sure we get it out to property investors. But thanks for coming in, mate. Appreciate your time.
Thank you.
Remember to check out smartpropertyinvestment.com.au. Social media, if that's how you like to get your info, just search Smart Property HQ. You track us down there if you aren't yet subscribing to our daily morning newsletter. So the first to know what's happening in property markets right across Australia. It's smartpropertyinvestment.com.au/subscribe. Any questions at all around this podcast or any of the themes or terms that we use, you can probably go and track them all down on smartpropertyinvestment.com.au, but you can email the team here and we can hook you in with Louis if that's what you want. editor@smartpropertyinvestment.com.au. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.